Alright, picture this. You're staring at your computer screen, a business plan open, a million ideas buzzing in your head, and one big, glaring question mark hovering right above it all. How much is this going to actually cost me? Specifically, if you're looking at a Northone business term loan, you're probably asking, what's the average interest rate going to be? Let's be honest, those percentage signs can make or break a business. It's the difference between scaling up and staying stuck. It's the difference between a comfortable profit margin and barely scraping by. You're not just looking for a number, you're looking for clarity, for a way to map out your financial future. We've all been there, right? You're trying to grow your business. You're looking at various funding options, and you land on a term loan. It seems straightforward. You borrow a lump sum, pay it back over a set period, with interest. But then, the real questions start. What's the catch? What's the real cost? And when it comes to Northone, a popular choice for many small business owners, the question of interest rates becomes even more pressing. They're known for their streamlined banking and loan application process, but that doesn't mean we can ignore the crucial details. Now, before we dive into the specifics, let's establish some context. Why are interest rates so important anyway? Well, think of it this way. Interest is the price you pay for borrowing money. It's the lender's reward for taking on the risk of lending to you. The higher the interest rate, the more you'll pay in total over the life of the loan. For small businesses, every percentage point matters. A seemingly small difference in interest rates can translate to thousands of dollars in extra costs over the loan term. That's money that could be reinvested in your business, used to hire new employees, or put towards marketing. So, you're looking at Northone. You've heard they're good for small businesses. They offer term loans. But what's the average interest rate? Here's the thing, there's no single, fixed answer. It's not like they have a big sign that says, our interest rate is X%. Instead, the interest rate you'll get depends on a variety of factors. First, let's talk about your credit score. This is a big one. Lenders use your credit score to assess your creditworthiness. A higher credit score generally means a lower interest rate because it indicates a lower risk of default. If your credit score is stellar, you are likely to get a more favorable rate than someone with a less than perfect credit history. Next, consider your business's financial health. Lenders will look at your revenue, your expenses, and your overall profitability. They want to see that you have a stable and growing business that can comfortably repay the loan. If your business is thriving, you're more likely to get a better interest rate. The loan amount and term also play a significant role. Larger loan amounts and longer repayment terms may come with higher interest rates, as they represent a greater risk for the lender. And, of course, the current economic climate matters. Interest rates are influenced by broader economic factors, such as the Federal Reserve's policies and market conditions. When interest rates are generally low, you are likely to get a better deal. Conversely, when interest rates are high, you will probably pay more. Northone, like other lenders, takes all of these factors into account when determining your interest rate. They also consider the specific type of loan you're applying for and the industry you're in. So, what does this mean in practical terms? While Northone doesn't publicly disclose a fixed average interest rate, it's safe to say that their rates are competitive within the small business lending market. You can expect to see rates ranging from the mid-single digits to the mid-double digits, depending on the factors we just discussed. To get a more precise idea of what rate you might qualify for, you'll need to go through the application process. Northone typically offers a pre-qualification process that allows you to see potential loan offers without impacting your credit score. This is a great way to get a sense of the interest rates you might be offered before committing to a full application. Now, let's talk about some strategies for securing the best possible interest rate. First and foremost, work on improving your credit score. Pay your bills on time, keep your credit utilization low, and review your credit report for any errors. Next, make sure your business finances are in order. Maintain accurate and up-to-date financial records, and demonstrate consistent revenue and profitability. You might want to consider working with an accountant or financial advisor to help you get your finances in top shape. When you're ready to apply for a loan, shop around and compare offers from multiple lenders. Don't just settle for the first offer you receive. Take the time to research different lenders and see what rates and terms they offer. And don't be afraid to negotiate. While interest rates are often fixed, there may be some room for negotiation, especially if you have a strong credit profile and a solid business plan. Remember, the goal is to find a loan that fits your business needs and budget. A lower interest rate can save you a significant amount of money over the life of the loan, but it's also important to consider other factors, such as the loan term, fees, and repayment flexibility. Now, let's address some common misconceptions about business term loans and interest rates. Some people believe that all business loans have high interest rates, but this isn't necessarily true. The interest rate you'll get depends on a variety of factors, including your credit score, business finances, and the lender you choose. Another misconception is that you need perfect credit to qualify for a business loan. While a good credit score is certainly helpful, many lenders, including Northone, offer loans to businesses with less than perfect credit. It's also important to understand the difference between APR and interest rate. The interest rate is the cost of borrowing the principal, while the APR, annual percentage rate, includes the interest rate plus any fees associated with the loan. The APR provides a more accurate picture of the total cost of borrowing. So, to summarize, the average interest rate for a Northone business term loan varies depending on several factors, including your credit score, business finances, loan amount, and current economic conditions. While there's no single, fixed answer, you can expect to see rates ranging from the mid-single digits to the mid-double digits. To get a more precise idea of what rate you might qualify for, go through the pre-qualification process and compare offers from multiple lenders. And remember, work on improving your credit score and keeping your business finances in order to secure the best possible rate. Ultimately, the key is to be informed and proactive. Do your research, understand the factors that influence interest rates, and shop around for the best deal. With that said, thanks for watching, and until next time.